Question is, I live in San Antonio. I'm building a house that'll be done in December, and I did a 270-day rate lock, which is kind of absurd, but with the rates going up, it looks like it was going to pay off. And my question is, should I aim to put more down up front? Right now, I'm looking to put down 20% on this new house, or is there some other method that you recommend that I do, or put down less than 20%? So that's my 2 cents. I've got a house I'm going to put on the market next week and try to do a lease back. But that's my question, and any thoughts or advice is most appreciated.
Paul, I'm glad you asked that question this morning. How are you this morning, by the way?
I'm great. I'm about to play a soccer game, as a matter of fact. So I got a few minutes before I go show these young bucks
up. Okay, man. Okay. Hey, listen, so I just need to get a little bit of information. Number one, we're going to show you, if we have time, why you want to put just the minimum down. Now, we need to figure out if we're putting more down because you want to save on interest and time, or you need to control what your payment is going to be. Which one?
Yeah, it would be more for the monthly payment. Right now, it's a little bit higher than I would like it to be estimated. So that's what would be the reason for it. I'm more comfortable monthly rate than I am anything else.
All right. So we need to take a look at that and take a look and do a little bit of opportunity cost and take a look at that and see what we can do. Now, what is the minimum you need to put down?
Honestly, I don't even know. I haven't even explored that. With the money I'm going to make on this sale of this house, I was just thinking 20% would be a good number, not have to pay any PMI, but I could be thinking the wrong way. That's why I came on to this morning.
Let me give you an example here of a client that I have now, and he actually used to live across the street from me. And he's an engineer, it's $400,000 mortgage. And folks, I'm going to change this. I have $200,000 on the screen. I'm about to change this to $400,000. And at the time, it was at 3%. Okay. And I know it's probably going to be higher now, but I'm just going to give it to you like he was giving it to me. All right. Is at 3%. And then he was wondering, listen, and he put the minimum down to get it to the 400,000, but he had an extra $100,000. So he was going to say, should I put the $100,000 down on this $400,000 loan so that I can have a $300,000 loan at 3% for 30 years? I told him, no, you want the $400,000 loan. And since he was an engineer, he went through the numbers for me and said, this is what we're talking about, Don. This is why I want to do it this way. So I'm going to do a comparison here on these two loans. All right. $300,000 loan, $400,000 loan. All right. At 3%, the payment is, let me do the calculation. The payment is $1,686.42. $1,686.42. That's just the principal and interest. All right. And then he says, well, the amount that the bank wants over 30-year span is $207,111. Okay. And then he says, well, if I put the $100,000 down, my payment is $1,264. And the total interest cost for 30 years is $155,000. Plus I get to avoid PMI. I still told him you need the $400,000 loan. So, and I said, now, once you get that $400,000 loan and you're making your very first payment, now he could afford the payment either way. I said, once you do that, where is your $100,000? He says, well, my $100,000 is still in the bank. I said, once you make that first payment, can you then apply your $100,000 as a prepayment to principal once you do that? Now, I'm skipping a few steps here, Paul, because I know you're lacing up your shoes and getting ready to go. All right. So when we do that and he puts $100,000 down as a prepayment, now you get to see cumulative principal and cumulative interest on my screen here. And we're going to go to cumulative principal down to about $100,000. Okay. Now, when you do that, it takes us all the way down to line 125 on our amortization schedule. In other words, his $100,000 as a prepayment knocks off 10 years, 5 months off this loan instantly. And he still has a $300,000 loan. You follow me so far?
Yeah, I am. That's interesting. Very, very interesting. A true gem. So Absolutely. I'm listening.
Okay. And so once he does that, he was hoping to save about a little over $50,000 by putting the $100,000 down, but it takes 30 years to realize that $57,000 savings in interest by putting the $100,000 as a down payment. But he's going to save instantly over $110,000 right now, instantly, by making a prepayment of $100,000. Now, both ways, he has a $300,000 loan, but he doesn't start out at payment number one on a 30-year note with his 300,000. He is 10 years, 5 months in on a 30-year note with a $300,000 loan. The only problem is, Paul, he does have PMI for 1 month.
I love it. I love it. That makes I didn't even think to look at it like that, but that's why you guys are experts. Great advice. I'm definitely gonna to investigate that and talk to my lender to see what they got up their sleeve. Now, from a lender standpoint, do they benefit one way or the other? Do they make more money or commissions? Should I be wary of any of those, whether they go with a bigger down payment or not? Just curious.
Well, a couple of things. They usually get paid based on a percentage of the actual loan. You want to watch that. So there are a lot of things to consider, but the bottom line is going to be this. If we know about interest cancellation, any fees that you have to incur, you're going to more than make up by saving a ton of interest, because it doesn't just stop there. I wanted to get to the end of this before you had to go, but I want to start at the beginning now, if I can, if you still have a little bit of time.
I do, and I hate to be the guy who's rushing. I came on here just hoping to get a quick deal.
Yeah.
I do have like 2 minutes, but I mean, I'm definitely showing back up, and I'll follow you and ping you if I have more questions. But yeah, I have a couple more minutes.
Well, let me take 2 minutes here, okay? The very first payment on this loan is on the $400,000 loan. Okay, the very first payment is 1686.42. That's just the principal and interest. That does not include taxes and insurance. So out of that, the principal payment is 686.42 and $1,000 going to interest. If we make that first payment, let's call it January, the 686.42 is subtracted from what we owe, and it takes us to the principal balance on line one of 399,313. Now, we don't owe anything else until February. So we're just going to hold right there. But the February principal payment is $688.14. That is the February principal payment. So here's my question to you, Paul. Do we have to wait till February to give the bank that $688.14?
You're asking me?
Yeah, I'm asking you.
I'm not 100% sure. Like I said, I'm still pretty far out, so I don't even know
Okay.
have the high level numbers for what they.
So let me put it to you this way. Do you have to ask permission to pay extra money on your loan?
I don't believe so. I have not asked that to the lender, but I wouldn't think so. No.
No, you don't have to. That's exactly right. So the $688.14 on this particular loan that would be due in February, if you had it, you could actually give that to the bank in January as well. If you did that, you're paid down to line two on your mortgage in January. Your next mortgage payment for February is actually on line three of the schedule. You get rid of line two on your amortization schedule for only $688.14. That's it. Line two is gone. The interest cost on line two is $998.28. You completely eliminate that interest payment of $998.28. It's gone. You never have to pay that just by making the principal payment early. So this is where I generally start this, but I didn't know if I had enough time to really get into that. And I wanted you to be able to see that when you do the replay. So I'm also going to show you what would happen if you make the January payment on this mortgage, and then you do a prepayment of line two, line three, and line four, just the principal payment. It saves you nearly $3,000 in interest on this loan.
Wow. No, it's powerful stuff. You know, it's just the problem. Not the problem, but the thing is, everybody says the right way to do it is put 20% down, and that's kind of what people believe. And
yeah,
obviously there's tricks to the trade, but no, it's all great knowledge. I'm going to go subscribe to that P.I.L.L method. And I got to run, but you guys are the best. Thanks for all the knowledge. And Jared, keep doing what you're doing, brother.
Paul, thank you for showing up today.
Have a good morning, guys.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.